Imagine a life where your money works tirelessly for you, even while you sleep. Picture waking up not to an alarm clock demanding you go to a job, but to a notification that money has been deposited into your account. This is not a far-fetched fantasy. It is the tangible reality of living on dividends. People often dream of financial freedom. There are many ways to approach it, but creating a stream of passive income is one of the most powerful. Our goal today is to explore how you could potentially generate $2,900 a month, which adds up to a comfortable $35,000 per year, using nothing but the power of dividend-paying investments. This isn't about getting rich quick, but about building a sustainable financial future. Before we dive into the specific strategies to reach this goal, it is crucial to understand exactly what dividends are. Think of it like this. When you buy a share of a company's stock, you become a part owner of that business. When the company makes a profit, it has a choice. It can reinvest that money back into the business to fuel further growth, or it can share a portion of those profits with its owners, the shareholders. That shared profit is called a dividend. It is a reward for your ownership and your faith in the company's success. These payments can be a powerful tool for building wealth over time without ever needing to sell your original investment. To evaluate how much you can earn, you need to understand a key metric called dividend yield. This number is a simple percentage that tells you how much a company pays in dividends each year relative to its stock price. To calculate it, you just take the annual dividend per share and divide it by the price per share. For instance, if a stock is priced at 100 per share and it pays out 5 in dividends over a year, the dividend yield would be 5%. This percentage is your friend because it helps you compare different investment opportunities and estimate your potential income. So, why is this so appealing? The magic of dividends is that they provide a steady, predictable stream of cash flow. For someone like our example investor John, who wants to earn $2,900 per month, this is fantastic. It means he can receive regular income to cover his living expenses, while his underlying investment, the stocks themselves, can continue to grow in value over the long term. This creates a financial engine that can sustain a lifestyle without depleting the principal. It's a way to have your cake and eat it too, turning your portfolio into a personal money-making machine that supports your financial independence journey. Now, let's explore our first strategy, which is often considered one of the fastest ways to generate high dividend income: investing in covered call ETFs. These funds offer a two-pronged approach to earning money. First, they hold a portfolio of stocks that can appreciate in value and pay their own dividends. Second, they use an active income layer. Fund managers write or sell call options on the stocks the fund owns. That process generates immediate cash payments, premiums, which the fund passes to you as higher dividend distributions. How exactly does option selling work? A call option gives a buyer the right, but not the obligation, to purchase a stock from the ETF at a predetermined price, the strike price, before a certain expiration date. For selling that right, the ETF collects the premium. That premium income often pushes these funds' yields into the double digits. For example, covered call ETFs like Global X S&P 500 Covered Call ETF, XYLD, have had yields well over 10%. This is significantly higher than most traditional dividend stocks or standard index funds. Let's plug in the numbers for our $35,000 per year goal. If a covered call ETF yields a trailing 11.8%, the math becomes attractive. You'd need about $296,610 invested to generate $35,000 annually. By contrast, at a 3% dividend yield, you'd need over $1,100,000 to hit the same income. The difference is staggering. Covered call ETFs can dramatically reduce the capital required to reach your income target. They can generate substantial income even in flat or slightly down markets. Constant option selling and premium collection create a steady cash flow stream, less dependent on market gains. That consistency makes them useful for covering living expenses month after month. For investors looking to accelerate financial independence, covered call ETFs offer a compelling high-yield path that can shorten the timeline to your goals. While the high yields of covered call ETFs are incredibly tempting, it's absolutely critical to understand that this speed comes with significant risks. There is no free lunch in investing. The primary trade-off with this strategy is that you cap your potential for growth. When the fund sells a call option, it agrees to sell the underlying stock if it rises above a certain price. This means that if the market experiences a strong bull run and stock prices soar, the ETF will be forced to sell its shares and will miss out on all the gains above that predetermined strike price. Your income is high, but your total return might lag significantly in a rising market. Another major risk is the potential for capital loss during a market downturn. The premiums you receive from selling options can provide a small cushion, but they will not protect you from a steep decline in the value of the underlying stocks. If the stocks in the ETF's portfolio drop by 20%, the fund's value will also drop significantly, minus the small amount of premium income it generated. This means your initial investment capital is not safe from market volatility. Many investors are drawn in by the high yield, only to be surprised when the total value of their investment falls, sometimes by more than what they received in dividends. Furthermore, the complexity of options can be a risk in itself. While you, as the ETF investor, don't have to manage the options directly, the fund's performance is tied to the manager's ability to execute the strategy effectively. The timing of when they sell options, the strike prices they choose, the expiration dates they select. This adds a layer of active management risk that doesn't exist with simpler index funds. A poorly managed strategy could lead to lower yields or greater losses than anticipated, making it essential to choose reputable and well-established ETFs. It is crucial to look beyond the headline yield and investigate the source of the distributions before committing significant capital. Section 4. Strategy 2. Our second strategy for generating that $2,900 monthly income involves a special kind of company known as a real estate investment trust, or REIT. Think of a REIT as a way to become a landlord without the hassle of fixing leaky toilets or chasing down rent payments. These companies own, operate, or finance income-generating real estate across a wide range of sectors. You can invest in REITs that own apartment buildings, shopping malls, office towers, warehouses, or even data centers. By law, REITs are required to pay out at least 90% of their taxable income to shareholders as dividends, which is why they are a favorite among income-focused investors. The appeal of REITs is that they offer a way to tap into the historically solid returns of the real estate market with the simplicity of buying a stock. Some specific REITs offer exceptionally high dividend yields. For example, you might find REITs in specialized sectors, like mortgage REITs, that offer yields of 15% or even close to 20%. These companies, such as Orchid Island Capital Two Harbors Investment Corp., can offer a powerful income stream. Investing in these high-yield options can drastically shorten the path to your financial goal, making them an exciting area to explore for anyone serious about living off their investments. Let's run the numbers using a more conservative and diversified approach. Historically, the broader REIT sector has delivered strong performance. If we assume a blended average annual return or yield of around 10.8%, we can calculate the capital needed to hit our target. To earn $35,000 per year with a 10.8% yield, John would need to invest approximately $324,074. Once again, this is a much more achievable figure than the $1 million+ required with lower-yielding traditional stocks. This makes REITs another powerful tool for accelerating your journey toward becoming financially independent. One of the best features of many REITs, especially for someone who needs to manage their monthly budget, is that they often pay dividends on a monthly basis rather than quarterly. This provides a more frequent and predictable cash flow that can align perfectly with your regular expenses like rent, utilities, groceries. Imagine receiving a, paycheck from your real estate portfolio every single month. This consistent income stream, combined with the potential for long-term appreciation of the underlying properties, makes investing in REITs a compelling and time-tested strategy for building a dividend-powered life. Section 5. Just like covered call ETFs, the high yields offered by some REITs come with their own set of risks you must be aware of. The performance of REITs is linked to the health of the economy and the real estate market. During an economic downturn, businesses may close. Individuals may lose jobs, leading to higher vacancy rates in office buildings, retail centers, apartments. When tenants can't pay rent, the REIT's income stream suffers directly. This reduction in income can lead to dividend cuts, sometimes suddenly and dramatically. REIT values are sensitive to interest rate changes. When interest rates rise, borrowing gets more expensive for REITs. Higher rates can make government bonds more attractive, causing investors to sell REIT shares and push prices down. Even if properties perform well, REIT stock prices can fall from macro shifts, reducing your investment's total value. Different REIT types carry different risks. Equity REITs own and operate physical properties. MREITs don't own property. They invest in mortgages, mortgage-backed securities. MREITs often offer double-digit yields but are complex and very interest rate sensitive. They use heavy leverage, which magnifies gains and losses, making them riskier for average investors. Diversifying across several REITs is smart, but sector downturns can hit many at once. A diversified REIT ETF can mitigate risk, holding dozens or even hundreds across various property types, geographic locations. That prevents overexposure to the failure of a single company or a slump in a specific sector like office buildings, shopping malls. Acknowledging and planning for these risks is key to using REITs as a long-term income tool. Section 6. Strategy 3. Our third and final strategy is arguably the safest and most reliable, though it requires more patience and capital, investing in the dividend aristocrats. This is an exclusive group within the S&P 500 index that have not only paid a dividend, but have increased their dividend payment to shareholders for at least 25 consecutive years. Think about that track record. Through recessions, market crashes, and global crises, these companies have consistently rewarded their shareholders with a bigger paycheck year after year. This elite list includes well-known blue-chip companies like 3M, Walgreens, and Leggett & Platt. The primary appeal of the dividend aristocrats is their stability and proven resilience. These are not speculative, high-flying companies. They are well-established industry leaders with strong balance sheets and sustainable business models. Their ability to consistently raise dividends is a powerful signal of financial health and disciplined management. While their yields are lower than our previous strategies, often averaging closer to 7% for some of the higher-yielding members, they offer a level of predictability and safety that is hard to match. This is the get-rich-slow approach, focused on quality and long-term reliability over short-term high income. So, how do the numbers look for this strategy? To achieve our goal of $35,000 a year, or $2,900 a month, with a portfolio of dividend aristocrats that has a blended yield of 7%, John would need to invest $500,000. Yes, this is a significantly larger amount of capital compared to the roughly $300,000 needed for the high-yield covered call strategies REIT strategies. However, what you are buying with that extra capital is peace of mind. The risk of a dividend cut is substantially lower, and these companies often perform better during tough economic times, protecting your capital more effectively than riskier, high-yield alternatives. The long-term power of this strategy comes from the dividend growth. While a 7% starting yield is good, the fact that it is likely to increase every year provides a built-in defense against inflation. As the cost of living rises, your income stream from these investments is also designed to rise, maintaining your purchasing power over time. A good way to approach this is to spread your investment across multiple aristocrats from different industries to reduce risk. While it demands more initial capital, building a portfolio of these dividend-paying champions is a time-tested path to creating a durable and growing income stream for life.